Yes, so we're looking now at accruals. Okay, accruals, these build up basically. Okay, if it's an accrued expense, it's an expense that accumulates. For example, if you don't pay rent for 1 month, you're still owing that rent money. It starts to build. The second month passes, you don't pay that rent, it builds. The third month passes, it builds. Okay, only until you pay it up, that's when it goes down. Okay, so accrued expenses are current liabilities. Okay, because they represent expenses which you haven't paid for, but you need to pay for. So they'll be building up. Okay, and if you remember the accruals concept, this is where the accruals concept comes in. Record expenses and income even though money hasn't been paid. That is the accruals concept. Okay, so let's look at the next. Oh, I'm already recording here. Yes. Okay, accruals concept, record expenses or income even though money hasn't exchanged hands. Okay, so we start with accrued expenses, which are current liabilities. All right, so for example, in your trial balance, you see wages 48,000. And then they tell you addition of information. There are accrued wages of 6,000. Okay, the accrued wages of 6,000. Okay, so you see the whole picture. Okay, here's the original journal entry. You debit for these wages, since these wages were paid out, right? So you debit the wages expense. Whenever you incur an expense, you debit. Okay, so since they are paid by cash, cash is an asset, reduction in an asset, you credit 48,000. Then you find at the end of the year, there are wages which are still owing of 6,000. So what you must do, you must include these wages since you're still owing them. Even though you haven't paid for them, you need to include them. So again, you debit the wages account. Okay, 6,000 to include these wages which need to be paid. Then you're going to credit wages payable or accrued wages. Okay, remember, increase in a liability, you credit. Okay, so in our statement of profit or loss, as you can see here, expenses, rent expense, you're going to add this 6,000 to the 46,000. Okay, this was this debit entry here. Okay, 46 plus 48 plus 6,000, this is 54,000. Because remember, colleagues, you want to record the rent of the, oh, these are wages. I don't know why I put rent expense here. Wages expense. You want to record the total wage expense you incurred that year. Okay. So you add the 6,000 to the wages. So 48 plus 6,000, this is 54,000. The balance sheet, this credit entry here, you're recognizing this as a current liability. So under current liabilities, you put accrued wages 6,000 here. Any questions, colleagues? Okay, we go to accrued income, which is a current asset. So again, let me use the landlord and tenant thing here. Okay, so you have a tenant. So for the accrued expense, I gave that example for where you don't pay rent for 1 month, 2 months, 3 months, 4 months. That rent expense is building on your side as the tenant. From the landlord's perspective, that's income that is building up for him. You don't pay rent for the first month, you're owing him rent. So to the income. You don't pay for the second month, that income increases again. You don't pay him for the third month, the income keeps on building. Okay. So accrued income is a current asset because this is money being owed to you. Okay. So let's say again, for example, here on your trial balance, right, you have commission received 48,000. Okay. Then, in additional information, it tells you there was accrued income, commission receivable of 6,000, meaning you're being owed a 6,000 in terms of commission. Okay. This 48,000, you already paid it. Have you seen the double entry? Debit cash 48,000, credit commission received 48,000. Okay. Then you find you're being owed an extra 6,000, which is your commission receivable. Okay. This is the accrued income. Okay. So the adjusting entry, you're going to debit commission receivable 6,000. This accrued income, you're recognizing it as a current asset. That's why we put this debit entry here. This commission receivable. If you see in a financial statement, commission receivable, rent receivable, interest receivable, those are the accrued incomes there. Then you're going to credit commission received. Remember accruals concept. Expenses and revenue or income. You're going to record them regardless if you've received money or not, or if you've paid money or not. You're still going to record. So we're going to credit commission received 6,000 to represent the true commission that we received for that year. Okay. So in the statement of profit or loss, you're going to add 48,000 plus 6,000, you get 54,000. This was the credit entry there, 54,000. All right. Balance sheet. Under current assets, you put commission receivable. This 6,000 here, represented by the debit entry. Okay, colleagues. So the point is for accruals, if it's an accrued expense or accrued income, you're adding. But just remember, an accrued expense is a current liability. So in the balance sheet, you put it there as a current liability. Accrued income is a current asset. So in the balance sheet, you put as a current asset. But in the statement of profit or loss, you're adding accruals.